U.S. is already in an economic recession. A million jobs in one report, in one revision, just is unheard of. The reason they're buying gold and the reason gold is in a quote unquote bull market, I think it's just in the very first stages of a bull market. It's not even really that gold is in a bull market, it's that the paper money is in a dramatically dangerous bear market. I think silver is a massive value. From that temporary prosperity comes the permanent ruin of currency debasement and war.
Ladies and gentlemen, so today we have Matthew Piepenburg, and today we will discuss the macro outlook of the economy. We will talk about the commodity sector, precious metals, portfolio structure in the current environment, and many other very interesting topics. So Matthew, thank you so much for being here.
It's my pleasure. Thanks for having me.
Thank you very much, sir. So we have so much going on right now with the US economy and everything. What's your macro outlook on what's happening right now, and what are you paying attention to, sir?
Yeah, I mean, obviously, I think all of us, whether we're in risk assets or in commodities, hard assets, or precious metals, we're all kind of looking at the same things with relatively similar views in terms of risk. In a very, very dynamic world, you could say, changing world. There are bulls and bears in every camp, and I'll certainly give you my opinions. I mean, at 30,000 feet, we definitely are in a world that's changing, and I think most of us agree in more unknown ways. There's a lot of conflict as we're at 30,000 feet, kind of going from a globalist kind of backdrop of the last 10 years, which you could argue euphemistically is a cooperative model, to a more protectionist model now, or what they would call neo-mercantilist, basically just my nation first versus a more cooperative globalist model. That's certainly, since the Trump election, has been in the headlines. And then we have examples of this conflict or this change in many forms. Tariffs and those policies, whether those are good or bad for the US or good or bad for the world, is a major debate. We have international relationships in the wake of those tariffs and other policies that are probably in global trade, probably at the worst since the 1940s, late 1940s. And if you look at academics like Mersheimer out of the University of Chicago, certainly out of the US, he would argue that our foreign policy since 9/11, which we're on the anniversary of just yesterday, it's probably been a disaster, as he calls it, whether it's in Iraq, Afghanistan, Libya, Syria. We have conflict in terms of headline making wars for the last few years, certainly the Ukraine, depending on what you look at, 1.5 to 2 million dead in the Ukraine. In Gaza, 50,000 out of a 2 million population and dead. That doesn't include injuries. We've got issues in other parts of the world too, Yemen, Cambodia, Thailand, Pakistan, India. So there's a lot of conflict, and we all have different views on that. And my particular biases aren't important, but we can all agree, whether it's Israel, the Ukraine, whether it's trade, whether it's protectionism versus globalism, whether tariffs are good or bad, fair or unfair, legal or illegal. There's a lot of conflict and change in the global setting. And so what does that mean for markets? Well, usually that conflict, as Hemingway says, comes when nations are reaching a period of debt danger, where debt levels get unsustainable or dangerously high. And that is certainly a topic whenever you're talking about markets, again, whatever the asset class, whether it's, again, stocks and bonds, commodities, and certainly currencies. When you have a debt crisis on top of a conflict in other areas, that's usually a perfect storm for higher risk and higher volatility. And the debt is not just a US problem. We're at record high levels of government public debt now at 37 trillion and counting. Global debt is well past 300 trillion, which is 3 times global GDP. So there's a major mismatch in income or GDP versus debt. That's certainly very true in the US, which is the home of the world reserve currency, which affects all countries and all currencies. And it's also true in the world, in the G7 in the West in particular, of extremely unsustainable and high debt levels. And those are macro theses or themes that are unavoidable in any discussion we get into. And in any theme that we talk about at the macro level, whether it's the Doge spending cuts in the US or US aid spending cuts or tariff policies and reshoring jobs, whether it's stablecoin legislation, whether it's talks about gold revaluation, or whether we're talking about market risk in the US in particular, which is the major markets for the world, the S&P. All of these things and all of the problems and all of the desperation behind those measures stem from this original debt problem, which again, we can get into the weeds on, but to answer your question, hopefully short for a short answer or long answer, a short question, these changing conflicts, this movement from globalism to neo-mercantilism, these conflicts militarily, these conflicts in trade, these conflicts in military risks, and these risks in the market, and these policy conflicts from tariffs, et cetera, and crypto and AI and market risk all stem from what I think is the central thesis, which is a debt crisis, which is really unprecedented in the history of capital markets, certainly in the history of US markets, and really in the history of global capitalism or any form of financial system. We've never seen global debt levels this high. So, whatever theme we get into, whether it's the stock market or whether it's precious metals, gold and silver, it all comes back to this problem of debt and these symptoms of debt and the policy symptoms from that debt are simply undeniable. So I would say that the debt is the main theme. It has a ripple effect on all markets. And the conflict and the setting of that debt, military conflict, trade conflict, unfortunately, are nothing new in history. Usually, when you have debt or a debt crisis, as Hemingway has famously quoted many times, when a nation's over its skis in debt, you see the temporary prosperity of what debt can give you. And usually that's ripping markets like we see now. But from that temporary prosperity comes the permanent ruin of currency debasement and war. And what we're seeing now is war and currency debasement, that is inflation, all around us in the headlines. And it's no coincidence. In fact, it's really history repeating itself.
Yes, so very busy times for economic analysts for sure.
For
But
sure.
everything that is going on, and I would love to talk more about that issue. But just before we go there,
Hmm.
I would just like to mention the recent economic data.
Hmm.
So it looks like we do have a slowdown in US with unemployment, with inflation going down.
Hmm.
What's your take, sir, on the recent numbers?
Well, look, the most recent number that I'm looking at, and there's so many. I mean, I agree with you. Before we get into the debt, the economy, and I talk about the. I mean, I live in Europe, I live in France, I work in Switzerland, but I'm very much American, and so I look at the American markets not just with a bias as an American, but because American markets, American economy, and certainly the American currency, which is the world reserve currency affects all countries. So when I answer that question, I look at America in particular, but certainly I'm very familiar with some of the numbers coming out of Europe too, which are distressing. Certainly right here in France as we speak, there's a budget crisis and a debt crisis. But the economic factors are woefully disconnected from a ripping S&P. And there's an important distinction to not confuse a stock market, which we'll get into, I hope, with an economy. They're very, very different things in terms of some of the numbers in the US, but we can look at Europe too, which is important. In my opinion, I've said this for the last couple of years, the US is already in an economic recession, and there's all kinds of wonky indicators to confirm that. There's the SOMS rule, which looks at employment numbers. There's wonky stuff out of the yield curve since World War II. It indicates we're heading into recession, the inversion and reinversion of the yield curve. There's a fancy thing called the Conference Board of Leading Indicators. There's the Labor Department data coming out of the Bureau of Labor Statistics. There's year over year auto sales and retail and manufacturing data. There's freight index data for train carrying of materials. Those are all, in my opinion, drastically negative for the economy. And it has nothing to do with the U.S. market. We have delinquency rates on credit cards in the U.S. at 13-year highs. We have car repossessions at 13-year highs. We have manufacturing that's flat. In other words, a lot of data mining of negativity. But one of the most interesting and I think fascinating numbers recently is just from the Bureau of Labor Statistics in DC, which is subject to a great deal of criticism from me and a lot of debate. In fact, Trump just fired the head of it for being too negative recently. But the Bureau of Labor Statistics just came up with the non-farm payroll jobs numbers. Um, and those can go up or down by 100,000 or 50,000. What's fascinating, and I don't think being discussed enough yet, the BLS's most recent non-farm payroll numbers were downward revised by nearly 1 million jobs, which is an extraordinary number. We've never seen anything like this. This is worse than what we saw in the US in 2009, just after the great financial crisis of 2008. It's an extraordinary number. In fact, it's even gone into the negative territory. 1 million jobs in one report, in one revision, just is unheard of. Coming out of COVID, we saw a huge spike in payroll numbers and the job numbers up to 800,000 right after COVID or right towards the end of COVID. Effectively, all of that is now gone. We're way below where we were even in the worst of COVID. To me, that is a sickening sign of an economy in stress, certainly a middle class in stress. Um, that is completely disconnected again from a stock market that's reaching all-time highs again, driven by basically seven names, a highly concentrated market. We call it the S&P 500, but it's really the S&P 7 because seven major tech companies, which are highly concentrated in AI investments, basically hold 40% of the stock market's market cap. To me, that's an incredibly dangerous and narrow stock market, which the risks are obvious and we can get into. But my point is the disconnect between the Main Street economy and a all-time high stock market, I think, is very concerning. And usually that doesn't bode well for the economy or the market. But again, my short answer out of the US in particular, but I certainly see it in France and Germany and in Italy and in Spain, cooling labor growth, but in the US, a dramatically falling labor number. And when you have this combination of inflation and currency debasement, which is coming from debt because you're monetizing that debt with money created out of thin air, the purchasing power of your euro and your dollar buys you less. You add on to that woefully poor employment numbers out of the US. You add on to that these indicators like car repossessions, credit card delinquencies, small business bankruptcies. Um, it isn't me trying to be negative for negative sake. It's just that these things are real. Manufacturing is flat. There's really no capex investments right now. Um, it's looking very much like the early 80s when we were going into recession in the US. So again, it's not just looking for the bad news, it's looking at the math. And the math is for most Americans and most of the middle class, certainly in the US, but I see it as much in the Europe as well, but more prominently in the US. Uh, in every indicator that I look at, that looks and smells and tastes like a recession to me. So it's a tough time. Again, in a backdrop of a rising market and rising geopolitical conflict, and frankly, a great deal of distrust across the globe in leadership, whether that's in Canada, whether that's in Ireland, whether that's in the UK, whether that's in France or Germany and these coalition governments, whether that's the weaponization of political lawfare against certain parties we see in Germany or we saw in Romania, and even in the U.S., very polarized left versus right, dis disjointed. I'd say the divided states of America, and we just saw. A brutal assassination of a right-wing political figure, a pundit in the U.S., very tragic. Just highly polarized conflict, highly polarized distrust of leadership in the backdrop of a very distressed Main Street economy and a very ripping Wall Street economy, which is really sad because the top 10% of American wealth own 90% of stock market assets. So there's a great deal of wealth inequality, a great deal of social unrest and stress, polarization, and frankly, very negative employment and recessionary indicators at the home of the world reserve currency. So again, I'm not trying to be doom and gloom or negative, but the cooling of wage growth, the cooling of employment growth, the rising of inflation, the rising of distrust for leadership, the decline of the purchasing power in your currency, your paper money, whether that's a euro or a dollar or Canadian, Australian, these are undeniable facts. And they're negative for sure. And I don't mean to be negative, but most people don't even need me to tell them this. They feel it. They feel it with the purchasing power of their currency. They feel it with the the rise in costs of living and the disconnect between what they need and what they have available to them. I think that's fairly common to most citizens of the world right now, certainly in the US.
Yes, and also in the US, about 60% of people don't are not able to cover $1,000 emergency expense. So add that to a slowing economy,
Yeah.
and things look very,
Yeah.
very dangerous. So
Hmm.
just Matthew, on the stock market,
Hmm.
um, if so we do see these signals of slowing economy, what do you expect to happen with the stock market at the current valuation? Because if you look at the AI sectors and everything,
Hmm.
things look really, really overvalued.
Yeah, and again, I'm not alone in this. And am a former risk asset manager. I ran a hedge fund during the dot-com bubble, and I created other ones with Morgan Stanley, and I saw many different views on markets, and I certainly look at markets, but then I really became more interested in precious metals, but I still look constantly at the markets, not just because it's a habit, but because what's happening in the markets does have an impact on commodities as well, which I'm now more focused on, certainly precious metals. Uh, Definitely overvaluation. I think even if you're bullish in this market, and there are not many bulls that I know of between coffees, off hours, unofficial conversations. You have to be bullish if you work for a bank. You have to be bullish typically if you're a portfolio manager with limited partners and investors. You have to always be, optimistic in some way, but it's hard to do when this market is so openly overvalued by pretty much every metric. I mean, right now the Nasdaq is trading at 49 times earning. That's not where the Nikkei was in 89, but it's nearly at all-time highs in terms of just grotesque overvaluation. I think it's worth a few minutes on the markets because many Europeans and obviously many Americans still have a great deal of their optimism and hope that the markets will continue to save them and beat inflation and protect them in their 401ks or retirement program portfolios, et cetera, because it has been such a positive market despite the economic disconnect on the main street. And I'm not here to say the markets are doomed this month or this year. No one can time a market correction, crash, implosion, mean reversion, but we can measure market risk. We can identify a market bubble. And I'm not alone in saying that we are in a bubble. I don't think that's a huge stretch. It's probably the most optimistic market I've ever seen. But a normal market correction, a normal mean reversion to get back to fair valuation would mean a 50 to 75% fall in the current S&P, which would be devastating to many folks who are planning to retire or live on their our portfolio in the market. And rather than just say that as a gold bug cynic or a doom and gloomer, it's important. I come from the risk asset space. I talk to a lot of portfolio managers who are still trading stocks and bonds primarily. So it's not just me as a gold bug saying the market's overvalued and dangerous. I mean, this is something that Gunlach out of the bond market would agree with. I think Ray Dalio would agree with it. He ran one of the biggest hedge funds in the world, Bridgewater. Druckenmiller, Jeremy Grantham, who's been retired now for many years, who ran GMO. All of these much smarter veterans of the stock market than I ever was have very similar opinions to me. And I think, we have to look at this with open and realistic eyes. There are some who argue that even with inflation, even with these risks on the Main Street economy in Europe and in the US in particular, that the markets can still continue to rise north based on the powerful technology, the AI meme. I've seen that story before during the great financial crisis leading up to that mortgages could never fail. They're the safest asset. I saw that meme during the dot-com bubble in the late 90s, early 2000, that, the dot-com, the Internet of Things was going to change everything, that was going to save us, that this time was different. We're seeing that meme right now with AI, that AI is going to make the difference and prevent these markets from ever having any kind of uh-oh moment because there's such a radical new and sexy technology, and these primary companies that are all investing significant amounts of money into AI will keep this market up. That's a positive sign, you could say. And there's also the argument that the Fed will always have the back of this market, that the market is basically too big to fail. If we saw too severe a dip, that the Fed would create more liquidity and support the markets directly or indirectly in some way. And so there's a whole generation of investors right now who haven't never really experienced a major uh-oh moment in the S&P or in the markets that wasn't immediately corrected. In other words, every dip was a buy. And I think that creates a moral hazard of believing that you're always going to be safe. And there's a lot about the markets. I think without getting too wonky, in my experience, which has been almost 30 years now in the markets, sadly, the markets are a market of stocks rather than a stock market. We used to look at things like Benjamin Graham, financial statements and balance sheets and good valuation. But I think the markets are more driven and more centralized now. I don't think free price discovery is really the key. The markets tend to go up when the Fed or the central banks are dovish, when they're printing money or keeping rates low. And the markets tend to hiccup when the Fed is tightening the balance sheet or raising rates. In other words, the Fed has become the thermostat in a way, and that's a very dangerous way to look at markets this overvalued. I mean, yields very do matter. When yields go up or when rates go up, the markets tend to go down. We saw that really from March of 2022 until June of 2023. Powell's at the Fed higher for longer. We saw the worst stock and bond correlated performance since the 1870s. So that was when the Fed was trying to raise rates to fight inflation, which they failed to do. But that more hawkish policy out of a central bank sent markets down. As soon as there's talk of rate cuts or more QE, markets tend to think that's a lower cost of debt. That's a tailwind for the markets and they go up. So all ships go up and down on a rising or lowering tide. And the tide is really determined, sadly, by the Fed. The problem with that, where a central bank really centralizingly controlling the risk asset markets, the problem with that is at some point, the Fed or the central bank can't control forever. And I'm going to throw my announcement. The Fed can't do that forever. And the question is, how long can this continue? How long can a central bank effectively support an S&P or support a risk asset market? And I think at some point, the arrogance of the Fed that they can control the bond market through, again, like a thermostat with rates up or down or balance sheet expansion, tighter or loose, at some point the bond market has more power than a central bank. And at some point there's a sell-off in bonds that the Fed can't monetize. At some point there isn't enough money to print to keep yields from spiking and the cost of debt from just becoming too expensive for the markets and for the country itself. Determining when that happens is very difficult. You have to be cautious. I think, my mentor and investors that I went to when I was investing in hedge funds, guys like Jeremy Grantham, have done what we call bubble studies. And these bubble studies, I think, are forgotten right now because, Jeremy was looking at the Nifty 50 in the 70s, the Nikkei in 89, the dot-com, and of course the great financial. You look at all these bubbles from 2008 back to 97, back to 72. Higher multiples often precede really bad times. And the current stock market today is the highest market valuation in US history. To me, that's not a good sign. That's a scary sign. Again, we saw this in 1929, 1972, 2000, 2007, these great big peaks just before the big sell-off. And people will say, yeah, but everyone's been talking about this for years. The markets just keep going up. And that's true. And frankly, even at these market highs, they don't compare to anything like we saw during the Nikkei in 89, which was trading at 65 times earnings. So you could argue this bubble can go higher, and you could be right. The problem is no one really knows what will be the tipping point, the needle that pops this bubble. And I can talk about a few of them, but you're really you're tiptoeing through a minefield at these highs, and you can chase these highs, and you can hope for the best. But history and math confirms what Bob Farrell always said is the most ignored kind of market force, and that's mean reversion. And if markets mean revert, again, we're talking about a major loss in these markets. And what Jeremy Grantham has taught me is that there are two things that investors typically make the mistake of, or they're tilted towards. And the first is the man is tilted towards preferring good news. They only want to see the good news. So when I talk about this is bubble territory or overvalued territory, no one wants to hear that because they're hoping for the best. And I understand that psychology. And the second big weakness and commonality of investors, which again is what Grantham said, is that there's really no interest in longer term thinking. I think people just want to look at the markets today and look at it tomorrow and yesterday and hope that the next 5 or 10 years will be like the last. And my warning to them, and I think the warning that Druckenmiller or Paul Tudor Jones or Grantham or anyone else or Dalio certainly, so it's not just me as a gold bug guy, the warning is be careful because anything that gets this high could still go higher, but the downside risk at this point to me is far greater than the upside risk. And the notion that this market will be saved by a central bank and that every dip is a buy is only good until it isn't. And sadly, I can't tell your listeners what is the sign or what will crack these markets. What will you look at? But I could say from my own experience, the two things I would be looking at is is really interest rates. If interest rates get too high, that makes the cost of debt too high. That tends to be very bad for markets. If we have a recession like we did during the dot-com bubble, that was really, as Steve Eisman said, it was a recession that caused that market to crash. So if we have a recession, that could be a needle. So a recession or raising rates, and I would also say for the Magnificent Seven, the stocks that are holding this market up, if they lose their net income margins, in other words, they've been making so many investments in AI, and I would say top heavy, poor investments in AI, overvalued investments, that if any of those Magnificent Seven start to mean revert, lose 30, 40, 50%. Again, Amazon lost 90% in the dot-com bubble. It didn't mean it was a bad company. It was just overvalued. I think if you look at net income margins and they start going south, that would be a sign to get out of this market. I think if interest rates on the 10-year go above 5%, 6%, you'd get out of this market. I think when the government actually officially announces a recession, you want to get out of this market. And when there's a big sell-off, markets go down a lot faster than they go up. So long-winded way of saying this is an extremely, extremely overvalued market. It's, in my opinion, heading towards a mean reversion. There are a number of needles pointed at this bubble. I think people forget as well that, we've had 22 bear markets since 1925. We spent about half of the time recovering from the pain of those markets, the next half enjoying the ride up. But the 1929 crash didn't recover until 1958. The 1972, when I was just a baby, that market bubble crashed during the oil crisis. It didn't recover until the mid 90s. The tech bubble that I benefited from incredibly in 2000 didn't recover until 2011. And the Nikkei, which crashed in 89 when I was still in high school, it took 30 years to recover. So when people see a bubble now and think it's going to be fine for the next 20 years, I would remind them of just these basic historical trends that if you get caught in a trough that the Fed or the central banks can't airbag back up, you could be looking at many, many years before you get those profits back. And depending on your risk level or your age, you got to ask yourself, can you afford a 30, 40, 50, 60, or 70% retracement in markets that isn't suddenly V-shaped recovery back up? Because again, I think investors have been lulled into thinking that any market can be recovered, and they've forgotten the lessons of 29, 72, 2000, 89, et cetera. I don't think there's any exception to this. I don't think this time is any different. I think this market looks a lot like the dot-com market that I traded in my 30s and 20s back in 2000. And, I think AI is extremely sexy and new technology, but so was the internet in 2000. So was automobiles. So were railroads. So was electricity. But they all become overbought and then they become oversold. I think we're enjoying the last hurrah right now of this meme in AI, which can take this market higher. But the risks, again, far outweigh the rewards right now.
It's a great analysis, so thank you for that, Matthew.
Mm-hmm.
Let's move on to the sector where the valuations could be more favorable, so the commodities and
Yeah.
precious metal sector.
Mm-hmm. Mm-hmm.
So on gold and silver, both
Mm-hmm.
performed quite well,
Yeah.
objectively speaking. And for me personally, it looks like there are still a lot of good things going into gold's direction with the deglobalization, with the central banks getting involved, and the fact that, at least in my opinion, the masses are still not involved with gold. At least
Right.
it's not something that I hear my friends talking about it, but they do talk about the crypto sector and
Mm-hmm.
Bitcoin for sure. So
Mm-hmm.
that's another indicator. So what would be your view on the current gold and silver valuations, and what are some of the factors that you're paying attention to?
Yeah, I think you're very right to make a distinction. I think a lot, but what's really driving the gold and silver price, and particularly the gold price recently in the last few years. I mean, first of all, it's important to keep in mind, um, your first point, it's mostly not retail investors. It's not the average man on the street talking about gold right now. It's mostly central banks, sovereign wealth funds, and big fishes, big whales buying gold, and that's pushing the price up dramatically. And the reason they're buying gold and the reason gold is in a quote unquote bull market, I think it's just in the very first stages of a bull market. It's not even really that gold is in a bull market, it's that the paper money is in a dramatically dangerous bear market because of, again, going back to our very first point, because of the grotesque amount of global debt. Central banks around the world have been monetizing that debt with money mouse clicked out of thin air, and that has debased the currency. It has caused the inflation, and that has led to the rise in gold, simply because gold is a better store of value. So again, a very 3,000 foot, gold is not rising, paper money is dying, and that's objective and empirical. And so central banks that are trying to think of how to store their money are preferring to store in a better store of value than a US dollar or a local currency, or a U.S. Treasury. They prefer to store in physical gold. And that trend has become accelerated since 2022 when the U.S. weaponized the U.S. dollar in the war against Putin. Again, whatever you think of that war is irrelevant. Weaponizing the global reserve, world reserve currency caused central banks, both friendly and unfriendly to the U.S., to move away from the US Treasury and hence the US dollar and move more into gold. So there's those bigger players that are very savvy about the purchasing power of fiat money who are tripling their purchasing of gold since 2022. And that is clearly why the gold price is going up. Sadly, not a lot of retail investors are investing in gold or silver, which we can talk about for a number of reasons. Just like gold, this gold bull market is misunderstood as it's not really a gold bull market, it's really a paper money bear market. The other sad thing is, for decades, gold has been intentionally misunderstood and misreported to investors on Wall Street or in the private wealth management areas that I come from, or in the registered investment advisory complex that gives advice about portfolio diversification and bonds and stocks and real estate and some tech, et cetera. That's the bread and butter of consensus think. And for decades, even when I was trading stocks and bonds and running a family office, for decades, gold was considered too volatile. I think that was just an absolutely disingenuous statement. In fact, empirically, for the last 25 years, gold has outperformed the S&P, even an S&P as bubbly as this one. From 2000 to today, it's returned 11 times its value, and the S&P has returned just 6.5 times its value. So, in not only in real terms, but in total return terms, gold has been outperforming the stocks and certainly U.S. Treasuries for the last 25 years. And yet, for 25 years, we've been told that gold is too volatile. That was just incorrect. Now, again, you can pick your statistical window and show times where the S&P, certainly Bitcoin, was dangerously outperforming gold. But overall, and in terms of the broad stock market index, gold has been dramatically outperforming for decades, and no one talks about it. Now they're talking about it because they can't avoid talking about it. At least on at the more macro level or the family office level. To your point, retail investors have been rightfully seduced into faster returns because there's nothing that outperforms on an annualized basis Bitcoin. But Bitcoin had a year where it was up 5,000%. So when you stretch those numbers out, Bitcoin is a very attractive speculation asset. To me, it's not digital gold. That's another conversation. Bitcoin has made many people very rich. It reminds me of the IPO era that I came up in, the dot-com bubble, where IPOs and pre-IPOs made us all very rich. I was very aware those pre-IPOs were overvalued. I'm just as aware that Bitcoin is too. Didn't change my mind. I still wanted to invest in it, but I knew at the time that it was a speculation asset, not a sound value. These IPOs were just being churned out by the hundreds, it seemed like every month. In a lot of ways, Bitcoin reminds me of that super speculation asset of a generation. I don't think it's a store of value. I don't think it's a medium of exchange. I don't think it's a unit of account. So I don't think it's an alternative currency. It is a speculation asset by its very definition, by its very behavior. but it has taken a lot of people into its arms because it uses the same macro argument that gold does. The Bitcoin camp has done a very good job. They agree with gold about 80%. They agree that there's too much debt. They agree that governments have lost control of their currencies. They agree there's too much control and centralization, that Bitcoin is an anti-fiat solution, and it's also kicking butt in terms of its valuation. So it's taken this narrative as an anti-fiat, anti-government, anti-centralization asset, just like gold is. And they've been more successful at marketing that narrative, and they've been more successful in the returns. Of course, what's not discussed as much are the 4 or 5 drawdowns of 80% or more, and the standard deviation in triple digits. So if you have the stomach for Bitcoin, and you have the conviction, and you're willing to wait it out, you're going to be either a hero or a goat. And I have nothing against that. People have to make that own decision. I don't laugh at Bitcoin investors. Some have done very well. Most of them come to me in Switzerland and convert it to gold, but that's my personal opinion. They know it's a speculation asset. Some are true believers. And we've always said it's fine if you're a speculator. I don't think it is a store of value by the very math of its behavior. Anything with that type of standard deviation and those type of maximum drawdowns is not just consolidating. It's simply not a store of value. I'm much more interested in something that preserves my wealth. Bitcoin can grow your wealth or destroy your wealth depending on when you come in. Gold is much less sexy, but far more appealing to me over the long term. I mean, its returns are fantastic, but we look at gold as a store of value, as a preservation asset. It's certainly gone up dramatically in price, and we love to see the price appreciation. But far, far more importantly, um, gold holds its value far better than any paper currency. I look at the dollar or the euro or the yuan or the yen or even the ruble or the Swiss franc. It's just a beautiful ice cube that slowly melts over time, whereas gold just keeps doing what it does best, holding the value. So our clients and myself, we prefer to save in gold, just like central banks are now doing, and spend in fiat, convert that gold to fiat when we need it. So I think a lot of retail investors have misunderstood gold and have been seduced into Bitcoin as an alternative fiat. I understand that. I think more and more are catching on that gold has outperformed even this market, and that as this market gets higher and reaches a tipping point where it goes to an uh-oh moment, I hope that more and more retail investors will look at gold as a way to protect them from that type of volatility. It doesn't mean that gold only goes in a straight line. It doesn't mean that gold can't retrace in price, even if there's a major market crash. Many people point to 2008 and say, when the S&P or the Great Financial Crisis happened in 2008, gold saw a huge retracement in price because people needed gold, or because they needed liquidity and they sold their gold. And the next market crisis, gold will go down significantly. I completely disagree with that, not just because I have bias towards gold, but gold in 2025 is very, very different than gold in 2008 when there was a crisis. If we have a market crisis now, my opinion and my understanding of gold is there won't be a sell-off in gold. It'd be quite the opposite. I think more investors will be running to gold at that particular point. And again, because gold today, unlike, 15, 20 years ago, is much more of a strategic reserve asset than it was in 2008. The Bank of International Settlements has given it tier one status, and it aligns alongside the U.S. 10-year. It's frankly a much better asset than the U.S. 10-year in every measure. It is now being traded in the BRICS as a net settlement currency. It is being used more and more in the energy trade. It is being stacked by central banks. It is being taken off the London and New York exchanges because more sophisticated nation central banks and investors want their physical gold, not their gold on these exchanges. All of these are signs to me that gold is a much more significant asset, not just an equity or liquidity or speculation asset, but a much more significant store of value, a much more strategic reserve asset, a much more tier one asset than anything like it was in 2008. So when the uh-oh moment happens, and as the uh-oh moments continue to happen, as people understand gold, like the BIS does, and I'm no fan of the BIS, or like Eastern central banks do, or like the Chinese and the Russians and the Turks and the Poles do, as they understand that better, because it's been deliberately misunderstood in the West, they'll be far better protected than they would be in a risk asset or a paper currency. And sadly, to your point, a lot of retail investors haven't figured that out yet, or at least looked into that. They'll say, I'm just selling my book. I understand that. But I think what's happening with the rise of the St. Petersburg Exchange, the Shanghai Exchange, what's happening in the COMEX markets, what's happening in the London markets, there's clearly a desire for physical gold only over any other asset. And again, I say that not as someone who's a biased gold executive, but as someone who's come from the risk asset space, from the hedge fund space, from the stock and bond space. And I invest in gold very simply because now I understand the risks in those stock and bond markets. But more importantly, to my original point, I understand the debt levels globally and in the US and in Europe are unsustainable. The only way to maintain those debt is to destroy the purchasing power of paper money. And therefore, the only option I really have is physical gold. And I'm not alone in that. So gold will go up in price only because paper money, because of debt, will go down in purchasing power. And again, when I was young, when I was a baby, a 400-ounce bar of gold would cost you 17 grand. Today it would cost you about 1.25 million. Again, it's not because that 400-ounce bar got more valuable. It's because the paper money needed to get it got more weak. And I think it's really important to get past my bias or my executive role in Zurich and for people to look at this objectively, do their own homework. You'll reach the same conclusions that myself and frankly, most of the Bitcoin guys I know and all the risk asset guys I know, we even guys who have a different view on the dollar, we all agree in the end that gold is the best anchor to have in this storm. And again, it's not a gold case anymore. It's a debt case. It's a risk asset case. It's a currency case, and it all kind of flows back to this debt crisis and the debasement of the money because of that debt. And the gold is certainly the best, in my opinion, way to manage that risk. Others would argue Bitcoin is. I'm not here to mock that. I just prefer gold.
Yes, I would just love to also get your perspective on silver.
Hmm.
So some people see it as gold on steroids during the bull markets, but of course it has different dynamics to gold.
Yep.
So what is your macro view on silver, and what I suppose dynamics would you be paying attention to in relation to the silver market?
I think silver is a massive value. It's a massive opportunity. I've got my daughter and son investing in it more myself. And I say that many people say if silver is the poor man's gold. I keep saying no, silver is the smart man's silver. It's still up significantly for the year. It has been for the last couple of years. It's done very well vis-a-vis the S&P. And yet again, many people still don't trust it or don't understand it. Um, you know, I think one of the reasons is, we're not seeing, and maybe this is too wonky, the gold silver ratio, hasn't gotten compressed. Gold has been ripping and silver hasn't done as much as people would like. In 1980 and 2011, we had ratios, gold silver ratios of 15 and 32. Now we're much higher than that. So why isn't silver doing more? We've got a 4-year supply deficit in silver. We've got open pit restrictions in Mexico. In other words, the supply of silver is getting tighter. The demand isn't getting high enough to push it to those real tough gold silver compressed ratios. But I think it's just a matter of time. There's a number of reasons why. First of all, silver tends to really outperform gold in performance when gold is in a true bull market. And you would say gold at 34, 3,500 is a major bull market. Actually, I think gold is only just beginning. So part of the reason silver hasn't caught up to, a much higher price, well past 50, 100, 150, or 200, is, in my opinion, gold hasn't even started its real bull market yet. It doesn't mean gold only goes in a straight line, but I think you'll start to see that little silver speedboat past that gold juggernaut at rapid pace once gold really does go into a bull market. And I think its bull market days are only beginning. But silver also is fascinating to me because it has a market cap of only 2 trillion. I mean, Nvidia has a market cap of 4 trillion. So the entire silver global market is less in market cap than one Nvidia AI stock. And I think what that means to me is, first of all, there's all it takes is a small demand change for silver because supply is so restricted. A small demand change in silver will send its price up significantly higher. So I look at silver right now as a fantastic Benjamin Graham value opportunity versus the madness of crowds, to Charlie McKay's point, in the stock market. And I look at silver as a smart man's silver, not the poor man's gold. I mean, you've got, I think, this Utah billionaire, David Bateman, just put a billion into precious metals month back. And I think it was 12.9 million ounces of that were in silver. I don't think that was speculation, greed. I think it was common sense. And we've seen a lot of the contracts on the COMEX market have been, we've known this since the 70s. The COMEX has been putting a boot to the neck of the silver price by just doing these naked shorts on silver and pushing the silver price down. But the short positions in the silver on the COMEX are getting less and less because there's just less and less silver to execute that price fixing, that legalized price fixing. So I think all of these things make silver a fantastic value. As Rick Rule, a person in the precious metal space that I respect greatly, said a couple of years back when I was at a conference in Florida, that silver rewards extravagantly but infrequently. And I think although it's done very well in the last couple of years in percentage terms, the real day for silver is yet to come. If you have the patience, it will reward you extravagantly. I think right now, silver is acting more like a base or an industrial metal than a precious metal. An advisor to Von Greyer's and my company, Alistair McLeod, another brilliant mind in the precious metal space, has been looking at silver just as much as the rest of us and other hard assets and commodities. And if you price them in gold, which is a more constant price than US dollars or euros, if you price them in gold, silver and other hard assets are well undervalued right now, just based on the gold price. And I think it's such a good value. But I think when you combine how inexpensive it is vis-a-vis gold, and the ratios are still spread, when those ratios compress and currency debasement really kicks in, we'll probably see at least a 4x move in silver before we even get the headlines of the dollar being crushed in an obvious way. So, long-winded way of saying I'm very, very bullish on silver, not as just a get in and get out trade, but I'm looking at silver well past its all-time highs and in the 200, 300 price range down the road. What date, what month, I cannot tell you, but if you are patient, it will reward very extravagantly. I think platinum's another hard asset, even a precious metal that's been completely misunderstood by most investors who are chasing AI stocks right now, understandably chasing with much higher risk. But, platinum is incredibly undervalued. It's a hard market to understand. It only has about 200 tons a year of supply, which is compared to 3,200 tons of gold or 25,000 tons of silver. So, in terms of pure supply and demand, platinum is a major value play right now. It wasn't long ago that the platinum to gold ratio was 1 to 1. In fact, even further back, it was 2 to 1. The argument against platinum has been that, there's no more catalytic converters, the green energy, the green new modern world, there won't be a need for platinum in these, or palladium or platinum in these engines. And I think that's just absolutely wrong. I think with AI burning energy, catalytic converters aren't going to be obsolete, and either is platinum. And I think all the supply restrictions in South Africa combined make platinum another good investment. But again, platinum and silver more for getting that alpha and that beta jump out of an undervalued and soon to be higher priced asset. But gold for me and for most of our investors is 80% of the game when we're looking at those metals because we're really just looking to protect the purchasing power of the wealth we have. And again, gold, whether you bought it in 1920 or 1820, 1720, 1620, 1420, it just holds its value better than any paper dollar or any paper currency, all of which inevitably destroy themselves through debt. And we're at that cycle now, which I can get into more detail. We're at that cycle now where the debt is so misunderstood, so grotesque, so deadly. As David Hume says, debt destroys nations. It is at levels we've never seen. So if debt destroys nations, nations are being destroyed. We see it again everywhere on the headlines in different forms, whether it's social unrest, whether it's political distress, whether it's military distress, whether it's gender issues, whether it's race issues, whether it's immigration issues. The real issue is economic, it's debt, it's broke, and the currencies are dying and people are frustrated. And gold is just an insurance against that historical inevitable moment where the purchasing power of your paper money is no longer good enough, and gold will be the real asset. But I think again to your question, silver is going to outperform in terms of the speed of its direction. I think it's already shown evidence of that, but I think we'll get to much tighter gold silver ratios in the next few years. And I think that will really accelerate once it's become obvious that the trust in paper money is no longer something politicians can walk around or talk around or go to war around or distract you around. And that's what they're doing now. They're ignoring the elephant in the room. We're arguing about so many things. The real issue is we're broke and our purchasing power of our paper money is being debased, and citizens feel poor because whatever currency they hold in their wallet or in their checking account isn't doing for them today what it did 10 years ago or 5 years ago or even a year ago.
Speaking of alpha,
Hmm.
Matthew, I'm a
Hmm.
big fan of the mining stocks in
Yeah.
gold and silver.
Hmm.
And before, when I was interested in those, I would buy them because I believe that the commodity price will get higher. But I
Hmm.
believe right now we're in a situation where even at the current valuations, the good companies, they're printing cash, they're doing really, really well.
Yep.
What's your big view on the big picture view on the mining stocks, and would you be interested in them at the current valuations?
Absolutely. And I mean, again, this depends on each person listening's own profile, own risk profile, own ability to take risk and stomach for risk. And I don't want to say greed, but yeah, if you can afford to take more risk, the mining stocks have a lot to offer. I do think there's generational wealth about to be made in this unloved sector for so many years, which has broken so many hearts. There is a number of issues, and I'm there. There are the Frank Justras and the Ross Beatties and the Rick Rules who have forgotten in an hour more than I'll ever learn in a lifetime about mining. They're brilliant mining executives who understand the Sturm and Drang of the mining space. And usually where they go, money follows. They just to be very, very patient. So when you're picking a mining stock, you have to pick the right ones. When gold and silver get even more obvious to the world, and they're already becoming more obvious, these mining stocks, when the cost of production is still significantly less than the spot price, these metals, some of these are going to just do massive multiples. And so if you pick them correctly, you will be rewarded. The problem, notwithstanding that macro trend, the problem with a lot of mining stocks is the management and the operations. And so that's why a lot of the generalists on Main Street, or excuse me, on Wall Street, don't touch the mining stocks because of the volatility. For years, certainly last year, mining stocks had the highest free cash flow in the S&P, but they were the lowest performing sector. And a lot of that is because of poor management, whether it's outright fraud or misuse of capex expenditure or distrust. There are, as Mark Twain said, in front of every mine is a hole in the ground with a liar standing in front of it. And so it's very important that you look for the right operational mines, not just the ones with the best science behind it or the best reserves underneath it, or the best geologists out of the best schools who can confirm the finds. It's the management, it's the use of the capital, it's the reinvestment of the capital, it's the dividends, et cetera. And again, that's where I'm not an expert because I'm at the point where I'm not into speculation as much. I'm not looking for that life-changing investment. I don't say that smugly. I'm an older investor now. I'm not who I was in my 20s during the dot-com bubble. I'm more interested myself in preserving what I have. And that's why I'm more just physical gold kept in a hole in the ground outside of the banking system, outside of the crypto system, outside of the tokenization system or anything that's trackable and seizable. That's me. If you're younger or if you have enough money that you can afford to take some risk and not be ruined by the loss of it, that's a very different investment. Or if you're extremely risk tolerant and you're willing to roll the dice and go into the mining sector, if you roll the right dice in the right mine and have the right patience, the multiples can be huge. I'm not here to give advice on which mines. I couldn't do it even if I wanted to on a public forum. I would just say pick your minds very carefully, listen to the experts in that space, look historically at the best management companies, because if you find the right companies, when gold and silver do far better even than they've done the last couple of years, and again, not in a straight line, these equities in the mining space are going to have historical highs. That's obvious. And I've told my kids who are in their 30s and 20s, do your research on those and put an allocation towards it. And I certainly know smart people in the mining space, and I've watched them make far more than I ever did in the dot-com bubble by being good at that space. I'm just not the expert in it, to be blunt. But for those who do their work, I think there's reward for it.
Yes, and I've done interviews with Rick Rule, with Ross Beach as well. They're really, really
There you
good.
go. There you go.
So
Good.
just before we wrap up, Matthew, I like to ask this question for the younger audience.
Hmm.
If we have an individual who's still at the beginning of his and her well building path, There's so
Hmm.
many choices now with the crypto sector, with the things that we're talking about.
Hmm.
What advice would you have for that individual so that they don't get burned too much and don't lose capital and a lot of
Yeah. Yeah, it's a very good question. I came up in the stock market in my late 20s, and I've never been modest about this or falsely modest. I did very well, but I was very lucky because I took risk. But when you're 27, 28, 30, and you don't have a mortgage and kids and tuition, you can take some risk. And I was very lucky to take that risk at the right time. But even though I knew I was lucky, I also knew how to think like that famous line in The Big Short, where am I going to get screwed? What could go wrong? Don't just look at the upside when you're taking risk right now. Um, for example, if you're gonna speculate in the S&P right now and you're 27 and you're going to chase AI, be commonsensical. I got into the bubble of the dot-com bubble at the beginning, not the end. In other words, in the late 90s, not 2000 or 2001 when it was already tipping. So if you're going to take risk in this market, still do it intelligently. Be aware of the risk and not just the return. That's my first advice. I would not chase an AI top. I would get an AI bottom. You could argue that's still at the bottom. That's up to you. I knew the dot-com bubble was a bubble, but I got into it at a bottom, not at a top. Because if you were in that same investment you made in 97 or 98, which could make you overnight millionaire, would break your heart if you bought it in April of 2000. In other words, you've got to look at the downside, not just the upside. Where are you in the cycle with AI? Where are you in the cycle with crypto? I won't tell you because I have my own bias. Do your own homework. And as excited as you are, make sure you think you're getting in early and not at the end. I think some of these opportunities are at an end, not a beginning. Again, that's a personal bias from my own experience. The other advice I would give, especially if you're younger, and I think the real opportunity isn't just chasing NVIDIA. I wouldn't chase it now. If you are chasing NVIDIA or the Mag 7 or some AI stock du jour, please take the time to look at its net income margins. Look at its net income margins. As long as they're going up over 52-week averages, as long as they're holding, that's fine. Even if they're flatlining, that's fine. If you start to see net income margins dip and then stay negative, that's when you need to get out. Don't get caught in the Nikkei of 89 or the dot-com bubble of 2001 at the end. Look at the signals on the net income margin. Those are very important. Look at the risk before you look at the reward. Those are my two pieces of advice. My third piece of advice, especially if you're younger, is even easier, is just wait for a bottom. That's the hardest thing to do. It's really hard to do when everyone you're hanging out with for drinks on Friday is giving you the story of their return and looking at their iPhone and bragging about stock X or crypto Y or meme coin Z, and they look brilliant. They're just lucky, like I was with the IPO. If you're really smart and you're young and you're patient, you're doing your homework, in some of these stocks or some of these opportunities, certainly if you're looking at the indexes like the S&P or the Nasdaq, I would just wait for a mean reversion. You won't catch the bottom exactly. You won't even catch the top exactly, but you'll know what it looks like when you see it. In other words, if you're 28 now and it takes you 2 years till you're 30 to get the S&P at 70% off, that's a great investment. That's a really good investment. It's very hard to do, especially when the world tells you the markets are only going to go up, the Fed has your back, mean reversion doesn't exist. It's a different world. This time is different. It's not. When you're 75 and you're at a top, I would sell. If you're 25, you can wait for this market to crash because you have nothing to lose. And then you can buy at or near a bottom. And then you have a chance to make a huge fortune over 10 or 15 years safely. That is a hard piece of advice to take when everyone you know is making a ton on an altcoin, a meme coin, or an AI stock. And so I recognize it's going to seem like bad advice from an old guy who's already made it and is condescending. But I think for young people, I tell my kids, put your money in short-term treasuries, get a little bit of yield, wait for a mean reversion. Whether it's next month or 3 years from now is irrelevant because you're still young. If you're chasing a top and you're on the wrong end of that trade, you're going to lose so much money, you'll have no dry powder to reinvest when there really is an opportunity. So I guess it's a long-winded way of saying, I hate to say it, buy low, sell high. Don't buy at tops. Secondly, if you are going to buy, you're going to chase some of these meme stocks, look at their net income margins very carefully, track them like you would track a pulse rate on a dying patient, because that is to me your signal to get in and out. And be as positive and optimistic as you are. be cognizant of the risks before you go in. Be cognizant of, well, things could go wrong, not just how things can go right. That would make you a more mature investor, in my opinion. So that'd be my advice to the younger crowd.
Yeah, that's a great advice, Matthew. So
Mhm.
these are all the questions I had, sir. It was a great conversation. Thank you very much for being here, and I hope to have you back.
Well, I appreciate the invite. Thank you so much.